All right, so welcome everybody. Thank you all for being here. And tonight's presentation, I guess, is the best money strategy indicators money can buy. There's a couple things that we want to look at. And I'm going to use TradeStation for multiple reasons tonight. Many of you know my TradeStation indicators and my proprietary histogram momentum indicator, as well as some of the other tools that I've been teaching for a long time to use, especially are what we like to consider as far as a volume histogram tool, a volume tool. I don't know how many of you have, I guess I should ask this, how many people have never heard of me or this is their first time seeing a presentation that I've put together? Are there any first time folks in here? Any first time visitors here? Oliver, JK's been a while. Okay, all right. Well, welcome. I see there's this little tool. It's pretty cool on this Omnovia platform that we use, and it allows me to see where everyone's from. And we've got several people: Paul, John, Shane, and John. Another John. We got two Johns. The funny thing is, one's from the west side of Australia. One's probably, it looks like he's in, I'm going to say, what is that? Brisbane, way up there in Queensland, probably. That's Paul Stitchberry. Paul, welcome from Australia. And that's a, man, you're here back from the future. We've got, I'm not sure if that's Charles Lau in China. Welcome, Charles. And I'm not sure if that's Beijing. It doesn't tell me where. It's just a dot in the map of China. And we've got, oh, look who we have here. We've got Paul from Germany, and oh my goodness, is it Bob Lehrer? Bob, I'm not sure if you're in Iraq or Iran because it's really, no, that's Iraq probably, or is it Turkey? I can't really tell from this map, but oh my goodness, thank you for being here and welcome. We're trying to got a solid Israel. Sorry about that, Bob. I couldn't I couldn't see from all the little mortars over there. No, I'm joking. I hope everything's well. We got our programmer from that helps with our stuff, and he's a student, and he's also a very good friend, Ben Brenner, and he's over in Israel, and it's just we all hear what's going there. So thank you for joining us. The map is very small. It doesn't really list all the countries there, so I couldn't quite see. And of course, we've got lots of people from the East Coast, the West Coast, up to Mike in, I'm not going to say Toronto, but somewhere up there. So welcome, everybody. Let's get going and tell you what's happening here in the world that we trade in. So we have the Russell's been a breakdown. As you can see, we've got the chart in front of you is the IWM, which represents the Russell 2000. This is the on-balance volume indicator, and this red thing, this little monster here, this red thing, if we were trading price, as I always like to say, if we were trading price, this would be pretty ugly. We just made another new breakdown low. That's the advanced decline. So if the advanced decline was price, it would suggest that the prices, the amount of stocks that are down, the last time, as you can see, that we were at that level that we're currently at, was back here in April when the IWM was just a shade little bit lower. Perhaps this is a little, we could see a continuation pattern, and we've got a little further to go in the Russell. We have further to go in Russell. One might suspect that maybe we've got a little further to go in the S&Ps over time. How much lower? You know, maybe we could get the spiders back to, you know, where we were, believe it or not, just in June, but that would still create you know, the late May highs somewhere in here. But we'll leave tonight's presentation, and of course, one of the trades that we put out just the other day was in an inverse ETF on dog. Notice that the advanced decline broke this little trend. We had a lot of really neat synergies of confluence of different signals that popped up, which I'd like to teach for you because, and also share with you some of the indicators that we're using that are working very well at this point in time. Now, there's a lot to teach in the field of technical analysis, and I don't want to bog everyone down, so I'm just going to get right in it. It's tomorrow, or right now, is the calendar of, even though it's still the 31st, it is now considered the opening of the 1st of August. So what's the next big move? And I guess in order to answer that, it's important to know how good the analysis techniques you use are, right? I mean, if you've been buying stocks and if you fell into the trap of, I think the comment I made in our own trading room, even as late as yesterday, was, my gosh, they're still putting out buy recommendations everywhere, and it's amazing. And there's a phrase: sell it, buy it when no one wants it, and sell it when everyone's got to have it. And everyone seems to have wanted to really get into the stock market as of recent days. And the irony is, we've got some major changes that's taken place over the last few months, namely quantitative easing reduction. So there is some changes going on, and there is some relative comparative analysis that we like to look at, and we shared with our friends and family of community members that came to the seminar with us, that we've been noting that the European markets have been selling off. And if I showed you another chart, we would take a look at the EWQ, the EWI, the EWG, and that would be Italy, France, Germany. If you take a look at those ETFs, overlay them on top of the S&P, and compare it just going back to even 2012, you'll note that they trade in sync, and there are times that the European markets actually have, at one point in time, led our markets, believe it or not, in that period of time. And I'm not sure if that's just the global influence or the switch between the different economy growth outlooks. But needless to say, we've been going almost tick for tat in those market relationships. And what's kind of funny is that about 3 weeks ago they started peaking out, and I think it was for one totally ignored by everyone. It just is incredible. But there's been many hints and signs of a turn in the market, and and I know that every email that you're going to open over the next day is say, "See, I called the top." I can't help but to laugh, but I mean, really, it's one thing to sit there and be bearish and selling the market all the way up since 2012, and you and I both know, everyone here knows, that there are those people out there. They've been selling the market all the way up. But if you've been with me a while, you know that we've been trading from the long side, and it was just up until about 3 weeks ago that we kind of went, "Hey guys, something's going here. It's a little, there's some warning signs," and we have been advising people to buy spider puts, to get short, look September and October puts. One of the things that we were doing in the techniques that we used, I'm going to share with you tonight. First off, what are the indicators and studies that I use? Seasonal and cycle analysis. That's right, cycle analysis. It's not something new to me. We've used cycle analysis for a long time, but it doesn't come into play all the time, so you have to look at it. We look at that for stock indices and stock sectors and commodities and Forex, to use the seasonal and cycle analysis. And I've already alluded to relative strength comparative analysis, comparing one product to another. So if we use relative strength analysis, we can say, well, how is corn relative to wheat? Or how is Coke compared to Pepsi? Or how is the Apple, the stock, how is it compared to the relative performance of A, the NASDAQ, which it's in, or B, the S&Ps, or C, the sector XLK? How is the relative performance? And or you could take a look at various sectors, like the semiconductors, and take a relative comparative analysis and say, what's overbought, what's oversold, what's not performing. And you'll find out, right now that, believe it or not, retail apparel, if you just take a chart, which I'll do real quick with you here, if we take a look at the XRT, which I'd like to take a gander at, if we take a look at retail apparel, now remember, going back, this is the chart that you're looking at on your left is a monthly chart. Chart on your right is a daily chart. In the last few days, it looks kind of ugly. we've dropped, if you can see here, we've gone from about 89 to about 83. So, you know, quick math, you'd figure you're down about 8% or so, right? So we've already had an 8% move in the retail space. The funny thing is, if you look at where we're barely unchanged on the year. It's the one sector that really hasn't moved. And there are some names in that space as we head back to the going back to school session. This one is TJ Maxx, which in the month of July, TJ Maxx formed a doji for the month. And if you take a look, there is this little indicator here. If you note that while prices are moving lower, you've seen just the overall trend of the market. You look at TJ Maxx, it's definitely moved lower. You'll probably say, well, gee, Shazam, that looks like a little bullish convergence there. I don't know what that indicator is, but it's making higher lows while prices made lower lows. So there are some other names which is kind of interesting to me. Another one is a little known company called Urban Outfitters. And I'm not saying that this is going to get you rich quick, but today, you know, relative performance to the overall market, you got to agree that this market was a lot stronger than the S&P 500, right? So it didn't. It's had a nice little uptrend. It didn't give a lot of move to the downside, and then you'd want to ask yourself, well, John, the funny thing is the price has actually moved up, and while that market has moved up, we have seen that whatever this histogram is you're showing us, it has showed relative strength in the fact that it is moving up, making higher highs as prices made higher highs. The funny thing is that if you take a look now to your left and look at the monthly chart, you'll note that it's actually down on the year. It hasn't gone anywhere. So cyclically speaking, retail apparel hasn't done that well in 2014, not like the need for speed or the need for technology has, you know. So you take a look at Microsoft, MSFT is the symbol, and I'm going to get to the point in just a minute. You know, about 2-3 weeks ago, everyone was hell-bent on buying Microsoft and Intel and Texas Instruments and the whole scheme of technology. Like they couldn't get in down here, so now they're buying up here. Yeah, maybe there's a shot it can go higher, but I think there's a better shot of looking for better trade ideas and looking at seasonal analysis in other sectors in the next few weeks. So anyway, that's what I'm talking about, looking at relative strength comparative analysis relative to the overall market, what's gone up a little too far and what hasn't performed yet. And then we have to ask ourselves, well, why haven't those retail apparel stocks really performed? Well, for one, you know, it's not their seasonal time frame of supply and demand, A. B, money has been very tight in the sense that this market has kept a lot of people out because they didn't believe the stock market's fundamentals and that's a fact. You ask a lot of people, are you trading in the market? And they go, hell no, I wouldn't touch this market. You and I are trading this market because it's what we do. Many of you are not new traders. I see Nora Post here. Hello, how are you, Nora? And Malcolm Solomon, good to see you from today. Jim Lewis and Dave Shear and Bobby and Bill McKee and Sonia. Sonia, I'm glad you made it back to Georgia from the trip. I'm surprised you even didn't find yourself on a new boat heading south again, right? That was such a great time. You and Doc are just wonderful people. Great times. And in the meantime, all the other indicators that we use were just here to help us to get a clue as to what our next trade is. And anytime you put a trade, there's always risk. So before I put a trade on, I don't look for high frequency trades. I'm not looking to get in and out of the market all the time. I'm looking for high probability trades. To me, if you said, hey, wait for a buy signal and maybe a retail apparel stock as kids go back to school, as we start to get into that seasonal time frame where people start to shop again, you know, that makes more sense to me than saying, hey, now that Microsoft's up 58% in the last 19 months, I mean, let's buy Microsoft now. I think my money is best served to look for a pullback. So that's where we use technical indicators rather than looking per se at all these other ways of hearing of opportunities, which is watching TV, for example. So anyway, we have moving averages and person pivots, and I'm going to talk about that in a minute because I think it's least understood by the masses, and it's available on multiple platforms. In fact, on TradeStation, it's, I think, one of the top downloaded apps out there, but I could be wrong. But I'm going to share how and why it's important and how we use that for not picking out support and resistance levels, but I think it's often misunderstood that person's pivots is used for helping to identify turns in the trend of a market, and that's very important, as well as momentum. But seasonal and cyclical analysis are two of my favorite leading price indicators. And you know, when I look at stocks, I look at advanced decline comparative ratio analysis. You know, I'm very big on that when it comes down to looking at the various stock indices. And the page here that I've showed is, this is the spiders, this is the Qs, this is the diamonds, this is the Russell, this is the NASDAQ Composite Index, and this is the New York Stock Exchange Composite Index. Now, if you guys have heard about market breadth, and people use the tick, and some people look at the trend, and you've noted that people use market breadth analysis, and it's very important to use market breadth analysis when it relates to the stock market indices. Now, why do I have an advanced decline on the spiders? Why do I go through all this work? Well, for one, I think the biggest mistake, and I generally reserve this for seminar attendees, but one thing that I'll just leave you with right now, if you don't stick around to the very end, because I got a nice position sizing formula for options traders at the very end tonight, and so you may want to stick around. But let me point out to you about the NYSE, a little fact for you. Over 50% of the stocks contained in the New York Stock Exchange Composite Index are interest rate sensitive issues, meaning they're also preferred stocks. But more importantly, the New York Stock Exchange Composite Index, all right, the NICE, that everyone uses the advanced decline models for, guess what it has? Bond funds. So if some stocks go down and some bond funds go up at times, looking at the breadth analysis there is going to maybe give you false readings. So we created and like to look at what's the advanced decline look like on the Dow? What's the advanced decline look like on the NASDAQ 100? What's the advanced decline look like on the S&P 500? So therefore, I'm taking a real close look. If I'm trading the S&P 500, I want to know on a given day, you know, in this situation, 107 stocks are advancing versus 384 stocks declining. Everyone can, you know, in this screenshot here. Well, this was taken, as you can see here, towards the middle of June. And just as one of our presentations, we were telling people, hey, guys, you know, this market is starting to show signs that we're making elevated new price gains, but we're not seeing follow through on the advanced decline analysis. You know, so it was already showing us that back even in late June that we were looking at potential divergences in the market. Another breadth indicator is developed by Sherman McClellan, the McClellan oscillator. There's two different versions, but the one that most people look at is the McClellan Index, and that's the one that I look at. And it basically uses a difference between a 19 and 39-day exponential moving average of the daily net advances minus the decline figures. Now, this is very interesting, and it's an important component of what we're going to teach tonight. Now, this is not, you know, if someone's never, ever, ever, ever traded before and they're brand new to trading and they go, wow, this seems complicated, I would grab you by the neck, make you sit down and say, before you spend 1 penny in the market, you better learn this stuff, because if this is too complicated, then just give me your checking account and give me your life savings, because you shouldn't even be in the market, because these are just very, in my opinion, basic tools that any investor managing their own money better know how to use. End of story. Because if you're going to start to trade the market with real cash, hard-earned money, unless maybe you're a trust fund baby like they have here in Palm Beach, then don't worry about it. Then have fun. But, you know, trading is a business, and I would definitely sincerely tell you, these are some indicators that you need to use, or at least the logic that I try to teach people makes sense. If the stock market's going up with a low amount of stocks within that index carrying the weight of the fair share of the weight of price movement, then you don't have a breadth or a broad-based rally. Therefore, prices are subject to decline. That's very important. So the McClellan oscillator actually helps to give us several different reads. Number one, we can get an extreme reading if the oscillator hits over. Usually we look at between 150 and 180, and then we have outer bands as high as up to 300. But typically when we get these extremely high readings, it shows that there is an overbought level, that if the theory is if all the stocks in the index are going up, there's nothing left to buy. It's all it takes is one or two entities of funds decide to take profits, and you're going to see a quick down move. We also could see and look for divergence patterns, meaning prices make a higher high, but we don't see a higher high reading in the oscillator. So we do get bearish divergence patterns. We get bullish convergence patterns. We can play extreme readings, and most importantly, you can also look for zero line crosses. Now, it's not that complicated. Just when the index reading gets too high, it warns you, hey, look out, beep, beep. This thing's getting a little overbought as a market as a whole. When it gets down to this green level, it just means, hey, guys, it's gone down a little too far, too fast. Watch for market movements. And then we get at times when the trend of the market's starting to move up, and all of a sudden it starts to go from maybe a little slightly overbought reading to an oversold reading. We get these what we call zero line rejects. The market taps that zero line and bounces right off of it, and therefore you get resurges back with the original trend. So the McClellan oscillator is a very fascinating tool. It's not really used for day trading, but it is used for swing trading and to alert you to conditions that if you feel the market's overbought, then you can turn to an actual tool that is talking about the breadth of the market and not related to the pricing of an indicator like stochastics or relative strength index or a moving average convergence divergence. Those indexes, those indicators are very popular amongst retail traders, but they are price-related indicators and not market breadth participated related indicators, okay? And then there's our person's pivots, which many of you people have heard about. We can use it on a daily basis, a weekly basis, monthly. We created the option expiration to look for time frames between, since many stocks and indexes are not really ending at the end of the month, they're ending or concluding or migrating towards the expiration of options, and options have become more popular now. So option expiration concept was pretty unique, and we also revealed that we've been using the quarterly time frames for several decades now. And I want to share with you what really I think is, it's the most obvious, but it's the most I think underused aspect of what person's pivots is really all about. So I wanted to share this with you tonight real quick because it is very important, and it is the complete aspect of what person's pivots. Everyone thinks it just predicts the high and low of a move. Well, it kind of does that, but what it really does is it really helps to determine turning points in the market. So let's just say, for example, I think there's a seasonal turn coming in the market. Let's say I have another esoteric type of market analysis that's not so esoteric to me, but cycle analysis. After all, if I go back here, market cycles, timings. There are cycles. There are moon cycles. There's tide cycles, right? There's cycles all over, right? So why aren't there people believe in cycles within the stock market, times that go through periods of peaks and valleys, buys and sells, right? So person's pivots really helps to determine maybe a hidden undercurrent current of the market by the use of a moving average. We use the pivot point, which is color-coded as blue, and then we have a moving average of that pivot point. What is the pivot point? The pivot point is a math-calculated figure that is derived by taking the high, the low, and the close of a given session. So let's say we take a daily basis. Today, we take the high, low, close and divide by 3, and we're going to get the pivot point. So if I take a moving average of the pivot point, think of it this way. If the short term, which is the pivot point itself, is above a longer term, so if blue is above gold, the market's deemed to be bullish. But when we see that little anomaly where the pivot crosses underneath the pivot point moving average, we have a detection in a change in trend in the market. Remember, this is not a moving average on the close. This is the moving average based on the close as it relates to the high and the low. So if you have a high, low, and close figure, if you have a range where the market may have a formation of, let's call it a shooting star, right? So for example, every one of you probably are familiar. I was going to use this little pencil tool and write, but I don't want to mess up the presentation, make sure everything's running smoothly. It's just going well so far. And if we use that short-term moving average concept, that when a short-term moving average crosses below a longer-term moving average, things change. And so therefore, let's take a look at this. I want you to focus. This is actually person's pivots with the projected targeted resistance in red and the projected targeted support in green. Now I want you to follow the blue and gold relationship here, all right? Note that over here, everyone can see this that I'm pointing to. I'm going to use the pen. If you note right here, note that the blue is above the gold. Note that the blue is above the gold. Blue is really above the gold. Note that blue is really above the gold. And again, blue is above the gold. Wait a minute. And all of a sudden we just narrowed. We just had a change. Blue is above the gold, but not like it was over these 2-3 other periods. But blue is still over gold. Note that blue is over gold. And blue is over gold. Now, what did I just say? How do we calculate that? We take the high, we take the low, and the close, add it up, and divide by 3. So if that's the formula that determines pivot point, then remember, the close is where everything's figured. So the close on this day, right here, the close on that day, when the market closed, it recalibrates the person's pivots, and then look what happened on that particular day. On the close, we have blue now below the gold. So on the close of that day, it was saying, hey, by the way, tomorrow, guess what, folks? Tomorrow, we might have a bearish day. So do you note the change? Do you notice the red and the green lines? Do you see how we also, as it changed, it projected a lower red and a lower green? Do you all see that? All right. By the way, look at this chart. It's from April of 2010. It's not from today. This is a daily chart. This is a weekly chart, excuse me, and the chart was on Green Mountain Coffee Roasters. It was a stock. It wasn't even a stock index. I fooled you guys. I had that specifically whited out just to share with you guys. I wanted you to focus on the person's pivot. So this is a weekly concept that note that we, at the end of that week, it all of a sudden identified the close of this week gave a turn signal, and then the next week the market went up to pivot resistance, came back down. Note the blue is below the gold. So the market actually did what? Opened a little higher, traded a little higher, slammed down, and still gave a bearish reading. The following week, market opened a little lower and didn't give you a chance to breathe, right? All right, so let's look at this together and see something here. So we got blues below the gold, and all of a sudden this day, blues above the gold, blues above the gold, blues bullish, it's still bullish. Wait a minute, something happened right here. Something happened on July 25th. July 25th is when that song ended. The bullish song, it ended, okay? The song ain't the same. It's different. It's got a different tune. Note that the blue is below the gold, blue's below the gold, blue below the gold, blue. Guess what? This is a 60-minute chart with the prices now back with person's pivots. Do you see where, as an indicator, if I can get, which is really cool, because now we're starting to say, let's say you had a higher degree time frame type of a situation where maybe somewhere in this time period here you were looking for the market to peak out. You had a longer term timing tool that said, hey, potentially the market could top out maybe a third week of July, maybe like a cycle analysis, something that said you want to be careful up here, something is changing the landscape of the market. And all of a sudden you say, well, you know, the market's going back and forth and we got the FOMC, but boy, I'll tell you what, you certainly wouldn't want to take a buy signal against resistance. Some of you know we're taking sell signals, and I caught myself getting spooked out of a short trade, took a small little profit, and seconds later the thing just crashed. I'm not afraid to tell you that. I got people here in the room that see me do that day in and day out. But what we did do was also identify that there was a change in the market, and the fact that we were looking for something to happen this month, we took action on it. And so we were able to participate in a move. Now, if you were, for example, bearish the market and you bought some puts in here or bought some puts in there, as the market starts to decline, what do? Well, in order to take a profit when you're in puts, you need the market to go down. You get a lot more money out of a trade to cover a put when it goes down, because you're not going to make a profit in put options if the market goes up. I mean, that's just the way life is with this trading business of ours. But needless to say, I want to also, allude to the fact that, I keep talking about this cycle analysis, right? And I don't know, I could probably ask you guys, how many people either heard me talk about or had mentioned before about the warnings? Now, I guess it's important to back up a bit and say, we were kind of bullish this market, especially in the technology space back in late April and May. We were calling for the market to go up in the technology sector based on this same technical analysis techniques. So I'm not one of these kind of guys that's been telling people to sell for the last 2 years or the last year. We've been actually trading from the long side up until about 2-3 weeks ago. And so what our message has been that we had a cycle high due in the third week of July. So you know that we were talking about that cycle high. Now, some of you would say, well, he probably just read it in a book somewhere. I just wanted to share with you because this is kind of an interesting, just to give you a past about my ability in looking at markets and trying to trade and being successful. I really got into looking at almost every aspect of the field of technical analysis, and I was looking at cycle analysis back in the 90s, as everyone looks at Fib. I mean, you go through every tool that possibly is, Elliott Wave, you go through everything there is, and you finally find something that meets and then you stick with. And I discovered, in fact, it was published in Futures Magazine back in December of 2002. I mean, that just seems like it was yesterday, but man, that's 12 years ago. I mean, I got more gray hair on my head. As much as I keep telling my wife I'm not gray, I looked at a photo, and apparently I think I have brown hair, but magically the photo looks like gray. I thought it was bad lighting. But back here, we did this article. It was what a featured article in Futures Magazine, which is a premier magazine back in the day, man. When the industry was just booming. And I had this cycles and stock futures. That was the big. That was the big article that I had written, and I'd like to kind of share that, cycles and futures. That was my article. I was real proud of that. It got published, and man, it was a lot of competition to get it. To be invited to get to do an article, but B, the competition was fierce. You'd write an article, and someone had a better article, and they'd say, no, yours is rejected. We got a better one. anyway, the point being is that we talked about this combining cycles with pivot points. Just to let you know, it was something that was really cool to put together, and I wanted to share this with you. I'd love to give you the article, but you know, we just scanned this and put this out there. In looking at cycles, one of the things that we discovered was a little 5-month cycle for lows, and we do look for cycles for highs, and we look for cycles for lows. And so the work and the research that I've done throughout the decades, you know, and I'm not impervious to using a little Fibonacci, as the article suggests, either. And in fact, there's a huge thing about bringing in Fibonacci. So I just want to let everyone know I'm not an anti-Fibonacci guy. I just find other indicators a little bit better. But we talked about Fibonacci and how all of this stuff works with the 11, this specific bottom cycle, the 11-week cycle. This was just an amazing cycle, and it's been and I'm going to share this information with you tonight because I think it is important in how we trade and how we can look for time-tested tools. And of course, cycle analysis was very important in that part of our analysis. So remember, when I look at seasonal analysis, it alerts us to supply and demand functions on an average over time. So if I could sit there and say, sell in May, go away, the stock market has a little bit of issues in May, and then you get the earnings in July, and sometimes we see downdrafts in August. That's just the way it is, right? And then September, Labor Days can be rough and rocky, and then October you get the lows, and then you travel up on a good year through the end of the year, and then you come into January, about the second or third week of January, and you get that January sell-off, the profit-taking for tax deferment purposes, right? No one wants to take a profit in December 31st because then you got to pay taxes, you know, 4 months from now in April. If you wait just another week or two, you get, after the pension fund money starts rolling in at the beginning of the year, what happens? I mean, this is just the way the market goes. You know, these are the events that help to create these supply and demand functions within the stock market. But a cycle is a little bit different. But if we can identify cycle highs and say, gee, I'm due for a cycle high in a period of seasonal weakness, now I want to look at some other tools to kind of like fine-tune to see if I can put together a solid bit of evidence, because if I'm going to put down a lot of money, or if I'm going to put any money down to risk, I want to make sure I can stack the odds in my favor. I want to count cards. You know what I'm saying? I want to go to Vegas and I want to be a card counter. I don't want to lose at the blackjack table. It's kind of hard to count cards on a 6-deck shoe anyway, but you get my drift, right? I want to stack the odds in my favor legally. I don't want to get insider trading, and that's what cycle analysis kind of helps us do with a longer-term aspect. So I really don't talk about this a lot. You never really hear me talk about cycle analysis, because as soon as I mention the word cycle, I'm going to lose about 100 people who are going to think, this guy's out, he's way out there. John is whacked out. But no, I'm not. Cycles are very important. People that use Fibonacci use cycle timing. A lot of people use cycle timing. They may not talk about it because sometimes it doesn't work. And I'm going to explain that in just a second. What we need to do is we need to use confirming tools. You know, in fact, I'm going to go over here. If you go in the bottom here, we've got this document file, and this is our room here. In fact, I'm gonna bring. We have all our weekly and daily analysis. I think 714. So if I go to my room and I go over here to the Documents tab, it's right there. That little Documents tab. I have written down on almost a daily basis of my thoughts and concepts. So I'm going to share this with you. This was 714. This is already, and this is for our members in our community. We put together this was a Monday. So this might be a little too much information here. But one of the things that if we go in here, you would see that, for one, we're talking about the seasonal analysis, and I'm also talking about that I think that and mention about that cycle that's due on the third week of July. So I think what we try to do is to put action into words. I think even my famous last words is start pricing put options using September or October expiration in some of the stocks in the weeks mentioned above. So we've had really neat analysis, and I think that for most people, you know, it's one thing to say that the market's too high and it can't go anywhere. It's another thing to say, hey, we were able to time this, and yes, I believe that if you use the right tools, you will put the odds in your favor. And then with better odds, you may have the confidence to put on a position. And most people that have struggled in the markets, that have had bad experiences before, or poor education, or no education, or maybe they're just not disciplined, they don't have confidence in what they do. And I think that this, if you start to look at the right technical analysis tools that make sense, and I'm not talking using the same old stuff, the stochastics, the MACD, and the Bollinger Bands, and all that stuff. That's what all retail traders use. I think the least used indicators out there really help give us an edge. Seasonal analysis combined with cycle, longer term. Now, cycle is not something you know, I don't believe in using cycles every day, that's for sure. But I do look at longer term cycles, and I'm not saying that we have a longer term cycle in the market. This is because here's what I wanted to share with you. First off, there's 4 important principles in cycle methodology, and the principles are summation, which is the measurement of 2 or more cycle lengths. So you want to make sure that there's, you know, that the length of the cycles, they coincide, number 1, and it's not just 2 points, but maybe 3 or 4 points in the past seem to line up accurately. Harmonic interactions is where we get prices react within a cycle. So you might have a shorter term cycle, like I'm going to give you a 38-day cycle, and maybe you get a 7-month cycle, and every 7 months you get a longer term cycle, and when it intersects with a shorter term like a 38-day, you might get an idea that you're near a peak in price. And then synchronicity relates to prices having a tendency to repeat at the same time. So just like when they're harmonically interacted, that they interact, and it happens that both those cycles come to a point in time and prices react at that same time. And proportionality is the time interval of tops and bottoms, and of course the price reaction at those points in time. So those are the main, you know, topics, methodologies that we use in cycle analysis. So this is a cycle tool, and this is the tool, that exact tool that I was looking for, a projection of a cycle high for the 3rd week in July. Now, being bullish in April and saying, hey, we have an opportunity to go up, and being in July, and it got a little, you know, it got a little tricky there, and it's really hard to kind of fight the tape here when everyone and their brothers and sisters are bullish the market, and you're sitting there and you got all these other acclaimed and famed technicians saying, yep, this thing's got legs, it's going to go up forever. And I look at this chart and I go, it just went from 2012 without any meaningful correction, and it's all on the Fed. Eventually something's going to give. And so our cycle analysis, and this is one thing I want to point out to you, not all times this is a cycle high that's due in the market, and the market went down. This is a cycle high here. The market went kind of down. It went sideways, but it went down for about 3 weeks. This was a cycle high, and it was late by about 2 weeks, but the market did go down. This was a cycle high. Look what happened. The market went down a little bit, but shot right back up in your face. This is a cycle high, worked perfectly. Cycle high did not work. So this one really didn't work at all. This is a cycle high, and guess what? The market did go down. This is a cycle high, and the market did go down, but it only went down for like 3 weeks. That was it. Now we have a cycle high due, and we've actually already been down, believe it or not, from that high for 2 weeks now, according to a weekly chart. Even if Friday was, or last Thursday was the high, let's just say, last Wednesday, it really is only 5 trading days. Thursday to Thursday is 5 trading days. But literally, last Thursday was 1 week, and this Thursday is another week. So on a chart, on a timing tool, that's really 2 weeks. Remember that, okay? So we can see that, wow, yeah, I mean, this is the most bullish of times in this trend, and yet while the cycles did identify turns, some of the cycle highs did better, some did not, like this one right here. Some did a little bit better, some were short term. So, you know, if you think about it, it's almost like every other one. You see a pattern I'm sharing with you? This one turned out pretty good. This one turned out so-so. This one turned out pretty good. This one was so-so. This one turned out pretty good. This one was so-so. This one turned out pretty good, and this one was so-so. What's this one going to do? So it's almost like it's alternating. It's an alternating type of signal or alternating type of cycle. So some cycles do better tops than others. What's unique about this one here, the current one that we have, the current one comes after a 5-year run, and right now we don't have on a weekly basis a major destruction in or decline in the advanced decline market breadth analysis. And so what we do, since this is a weekly chart, we're going to have to wait till Friday to see what that advanced decline line does. Does it break down significantly, or does it cross this little dotted moving average? So in order to figure out how much downside, we have to now take it almost one day at a time and say, is the market breadth really declining, and are we getting a significant move using this volume indicator? You know, back over here, if we take a look at the same situation of the alternating time periods of market corrections, these little tiny corrections, and if we take a look at down in here, we'll note that, yeah, you know what, we got advanced decline readings that went down on low and the volumes. This went down, and that went down, and this certainly went down, and that went down, and that certainly went down, and that went down, and yeah, that went down a little bit, and that went down. So when this failed, look what happened. It went down and right back up, and it didn't even go down on any volume. The volume did not decline. So what we have to do in order to measure whether or not this is a more pronounced correction, meaning will it last more than 2 weeks or maybe 3 weeks, we're going to have to, wait till Friday, which is tomorrow, to really get a better read on the weekly longer-term analysis. But as you can see, the cycle finder does definitely aid in identifying in time tops in the market or potential peaks. Now, when we combine that with a longer-term cycle, now this is very interesting information for me as a trader, because I look at this and I say, okay, so that's a cycle high, and the market did go down, but in 1998, that was probably long-term capital management and just smoke. Now, note that this is actually a high, but it's not a related harmonic cycle high to this cycle. Note that we had a cycle high here, and the market did go down. We had a cycle high here. The market went down, but meaningless. It didn't really do anything. We had a cycle high due here, and it came the actual high came in a little early, but needless to say, that market puked. We had a cycle high here, and that market puked. And then all I can tell you, we have a longer-term monthly cycle that came in right now. Bizarre coincidence? It's a coincidence for sure. But there is a harmonic interaction between this longer-term cycle and the shorter-term cycle. Now we need to measure if this thing is going to be meaningful. In other words, you know, I don't know what causes these big sell-offs. I mean, well, we know what caused 2007, right? We kind of have an idea of what caused, you know, the one that occurred in 2000, right? It was the supposed tech bubble. But, you know, look at the magnitude of the rally here, and look at the magnitude of the rally here. You know, if you look at the magnitude of the rallies, this one, I mean, it had a little minor correction. So if we take it even from this low and measure it up, just to give you an idea here, I mean, if you look at that measurement, sorry about that, I'm going to have to do this again. I got a little squirrely with my writing. I'm not perfect. I do have character defects, trust me on this. There's people here that sit in my, that know that. But I mean, you can see what my point I'm trying to get to. These cycles, if we measured the cycle lows, these cycles, we kind of tend to look at this last move as almost a extraordinary extension that's literally lasted like about 2 years. And if you look at this, or not 2 years, but 2 cycle times, this is 2 cycle periods, 2 cycle periods, this is 2 cycle periods, this is 2 cycle periods. So if you look at the 2 cycle periods, it's what is it definitely would give you an idea that, man, if you were even, you know, in first grade, you would say, you know, I would think if you're interested in buying way up here after that huge straight move, the odds, and I don't think a first grader even knows about probabilities, but they would probably say that's, boy, that started down here and it's all the way up here. It might be time for a nap. That's what a first grader would say, right? It might be time for a nap. And I'm not sure we're going to see that type of magnitude of correction, but we definitely can look at a chart in the terms of cycle analysis and say, hey, you know what, we're due for a pause, and that's where we use the interaction of various technical tools. So again, not all moves are proportionate, which makes some cycles kind of hidden, and not all cycles respond on the exact time. And here's an important aspect. You know, we have holidays which can throw or alter a cycle off. So maybe the 4th of July, you know, it was on a Friday, so maybe that altered because the market was closed. Maybe that altered the cycle for, you know, the third week of July, because there was how many weeks in July? It was almost like 4.5, almost 5 weeks in July. It was a long month, but so that first week of July was kind of like it was the middle of a week. So therefore, holidays and months ending in the middle of the week, like we had for July, you know, can tend to throw off a cycle, so it's important to adjust cycles. Leap years, for example, something there can happen. Traders tend to heighten their attention to cycle highs, like I did, which we tried to warn people about, that's due in a seasonally weak period of time and a cycle low in a seasonally strong period of time. So it's important to use confirming non-correlated indicators. And again, if this is the last snapshot, just to share with you guys, if you find this, you know, a little interesting, this was when the cycle is due, and if we take a look at this, as price is making a new high, we're making a new high, but look at the market breadth analysis. It did not make a new high, it diverged, and the volume diverged, and that was one of our big concerns. So this is what gave us a better clue, and then timed with the person's pivot, that it started to say, hey, this thing has just gone from a bullish trend to a potential bearish trend. We had something in here that required immediate action. Buy some puts. Now's the time. You can time this a little better. In fact, we even put out a trade recommendation to buy this little inverse ETF. It's called DOG, D-O-G. The symbol is D-O-G. Seriously, DOG. DOG's an inverse ETF and as it relates to the Dow Jones Industrial Average. And just to share with you why we did that is real simple. If I show you the Dow, note that the advanced decline had more of a significant decline the other day. Look at that. It had a more significant decline yesterday. Look where the advanced decline was yesterday. It made more of a significant break, therefore giving us the clue that maybe the Dow is the one that could conform to a bigger break. So we went with an inverse ETF even yesterday, despite Janet Yellen. And in fact, it was because of Janet Yellen we got filled. But there is a rhyme or reason that when you get action and you have an idea of a cycle or you have an idea to get short, you need a trigger, something to finally trust to say, okay, I'm going to get into a position here, and of course that's when you apply your risk management techniques. So there is significant use and specific use for these tools. And I want to share with you one other thing, and I want to include this incredible opportunity we're going to give you, but I also want to show you about a position sizing. But first, I want to introduce my friend Mitch Field and have Mitch come in here. He's with TradeStation, and he wants to really show you something that's incredible. But we have a seminar that we're going to be giving here in October, a workshop in Palm Beach. And what's truly unique about this, I'm doing this with another trader. He's not a teacher. He's actually a doctor, a medical oncologist. He's not a doctor, a dentist, a doctor, a veterinarian. He's a real doctor, medical oncologist, and he has been studying and trading in the markets here. And this event is going to be with Dr. Jeffrey Scott, who's going to say, hey, here's what I've learned. And he's been one of our students, and he's really done an amazing amount of trading in his own right. And we're combining forces, kind of like the, here's John Person, and here's what I teach, and here's Dr. Jeffrey Scott's, here's what he's learned and how he applies it in his own trading account, which is extremely substantial for a retail trader to learn. And he's been one of our students, and he's really done an amazing amount of trading in his own right, and we're combining forces, kind of like the, here's John Person, and here's what I teach, and here's Dr. Jeffrey Scott's, here's what he's learned and how he applies it in his own trading account, which is extremely substantial for a retail trader. But in any event, this premier exclusive event will include a brand new thing we did on the seminar at C's. We have the high close, low close doji indicator and strategy for TradeStation users. It comes complete with a stop loss objective and profit target. So I'd like to introduce Mitch, because he's going to talk about some of the things that they can do for you at TradeStation. Because I think everyone, no matter where you trade, you should have at least a second account, a backup account at the very least. And TradeStation is going to offer you some incredible value here. So I'd like, if Mitch is available, if he could come in here and just say hello.
Wonderful. I want to thank John and Mary and, of course, Persons Planet for inviting TradeStation to participate in the webinar today. I see a very full room, and I see, like John, people from all over the world, which is great because TradeStation is also all over the world. First, let me start off and just introduce myself very quickly. I'm a supervisor at TradeStation, and I'm actually going to be celebrating my 10th year anniversary in August. So I've been here a while, and I love TradeStation. My contact information is on the screen, so I thought I'd give you guys a quick minute to just jot it down. Of course, any questions, I'd be happy to answer one-on-one after the session. Feel free to email me tomorrow as well.
Hey, Mitch, if I may add,
yeah.
People aren't really familiar with the incredible features of TradeStation. You see their commercials, you may hear about them. I mean, TradeStation is, the premier in back testing platforms of, the first ones, and they came out with the whole thing. But here's what the neat thing is, if, what we were going to talk about is that with TradeStation, with all those incredible benefits, if you were to look at any of the offers that we've ever made, TradeStation is going to, and that's why Mitch wanted to explain this. I just wanted to jump in so people understood. What's the tie-in? Well, we're doing a seminar here in Palm Beach, Florida, and if you open an account with TradeStation, whether it's you have an account at Fidelity, Toss, Schwab, wherever you open up another account at TradeStation, and someone asks what the minimum account, and Mitch will get to that in just a second. But what they'll do for you, if you trade through TradeStation, they will give you a commission rebate so that the cost of your education is rebated and credited back to you. It's an incredible offer. That really is fabulous. So you get your training, and coming to this special seminar, which I'll get to in just a minute, is fabulous. But in any event, what is the minimum that people can open an account with, Mitch?
John, thanks for that, bud. 5,000 for equities, 5,000 for futures, and 2,000 for forex. And John is right. We do not offer this to everybody. In fact, anybody who opens a new account with TradeStation, and it can be a backup account, like John said. It could be an IRA, a Roth. It could be your spouse's account, your spouse's IRA. It doesn't matter. We will give you a lifetime waiver on the TradeStation platform. Guys, I just said a lifetime waiver. Normally we charge $100 a month for the platform and $59 for Radar. But because John invited us into this room and because John is one of our biggest partners in this program, we're going to up the ante, and we're going to give you, in addition to the offer, in addition to a 20% rebate on any and all TradeStation commissions you generate, we will also give you a $500 rebate, which is dollar for dollar at the front end. So you get a $500 rebate at the beginning, followed by a lifetime waiver on the platform, followed by a 20% commission rebate. Is very, very easy to overlook. We know that there are a lot of tools on the platform, and we know that there is a ramp-up time to learning those tools. So we will jump in the water with you, and the day you fund your account, you're going to get a 1-hour session with one of my tech trainers roughly a week after you open your account. He will WebEx into your computer, help you set up the platform, and he will even answer questions on how do I do this or do that. We also have hundreds of hours of free education training and direct market access. I'm going to stop for a minute. I do see that somebody asked a question on what the minimum was, so I actually covered that. It's a good point to discuss it on this page. The minimum to open an equities and or a futures account is $5,000. Forex is $2,000, and please remember, each account is segregated, so each account must be funded separately.
Radar here, which has the person's pivots. It's an incredible tool. It tells us what a stock or commodity or futures is. It tells you what the monthly support is, and what it does is it tells you that right now, if you take a look at, for example, this USB right now, if you take a look at USB, if you go right over here, you'll note that today it's green, highlighted at 42.12 because that was the monthly pivot support. So you know that the market is trading at monthly predicted support. In addition to that, the Radar screen, you can create your own whatever you want to do on that Radar package, and he's not joking. It's $100 a month. They're going to waive that for you. But as far as what we're teaching, and this is the whole point, when we come to our seminar, Dr. Jeff Scott will be teaching as well and saying, hey, here's what I've learned, and this is the application from John that I've learned, and as well as his other past education, and this is how I apply it. So you're not going to hear from me. You're going to hear from an actual trader that's taken our information and applies it. But more importantly, we're also going to have, if you have an account with TradeStation and you attend, you're going to get this strategy, which Mitch was just talking about with TradeStation, the hybrid type of thing, where if you want to automate a strategy, it will, or if you want to just, kind of like use a little discretion, the high close, low close doji indicator, it gives you the trigger to get long. It shows you where your stop should go on a defined set of rules, and it gives you what your first profit target is. So if you know anything about the high close, low close doji that I've written about over the last decade and a half, then you will really come to love that indicator tool. It's awesome. So with that said, what are we going to talk about? Well, at this seminar, this workshop, we're going to talk about not just seasonal analysis, cycle analysis, timing tools that we use, how we scan for opportunities, letting the software do the heavy lifting for us, talk at extensive length about comparative relative strength studies to help us understand relative to other markets what's overbought, what's oversold, so we can find opportunities and then track it down and hunt down those opportunities in those trades. We're going to discuss market internals, option strategies using, of course, many of you have taken a lot of option courses. I've been trading options since they first started at the Board of Trade in 1984 on bonds. Many of you know that. Pivot analysis, how we use pivots versus Fibonacci's, and my favorite chart patterns that we look for, and the setups, my entries and exit strategies. And of course, this is the least discussed, is managing risk, stops, and of course, position sizing. And as I promised you earlier tonight, I have just an example. This is just an example. It's not a big deal. But, I mean, if you have an account, you say, well, instead of putting in a stock position, I want to put on a strategy. And if you understand options and you can look at your implied volatility, and if you find that buying options is relative to the implied volatility, it is better or gives you a better edge to be in a debit or what we call a vertical spread, where you pay for that spread rather than a credit call spread or a credit put spread. How many should you be in? And that's the question. We always, there's an old adage on the floor that we used to say, whenever you're right, you're always in 1. Whenever you're wrong, you're always in 100. I don't know if you can relate to that. It's being over-positioned when you're wrong and under-positioned when you're right, like this move we just had that was predicted that we gave. So if you weren't in the right amount of positions, then you need to learn option position sizing. So for example, let's say you were going to get in a vertical put spread in the spiders. Let's say you were going to do a 1-buy, in other words, like a 198, 197 put spread for September. So let's say you were going to do a debit put spread a couple weeks ago and you didn't want to spend a lot of money and you had a spread of around 38 cents or $38 per strategy. If you were going to risk under 1%, like 0.75% for one trade, right? One trade on an option, using a 0.75% risk consistently. So every time you put on an option trade, you are only going to risk 1% of your total account. So if your total account is $100,000, then if you have $38 strategy, how many of these strategies should you be in? And the answer is 20. So if this trade didn't work, you know that you should be risking less than 1% if you're only risking 1%. So maybe you want to risk 5%, 2%, 1% per trade on an option strategy. There is a method to the madness of how you can be consistent in how many positions you put on. It isn't about it's not just about the good analysis. Everyone needs that because let's face it, we've all seen every single pundit try to pick the top in this market and they didn't do it. They might finally have gotten short or they're finally getting some of their losses back, but you know what? It's going to take them years and a bigger crash in order for them to make back all their losses. I know people that have been sitting here rolling 3 and 4 times in VIX or UNVX trades, and they will probably never see their money and all the losses by rolling these positions. So people have been guessing the market, and if you had better tools to analyze the market and better techniques, find out from people that really know what they're doing, the leaders, and find out from traders that are putting to action. It's going to take them years and a bigger crash in order for them to make back all their losses. I know people that have been sitting here rolling 3 and 4 times in VIX or UNVX trades, and they will probably never see their money and all the losses by rolling these positions. So people have been guessing the market, and if you had better tools to analyze the market and better techniques, find out from people that really know what they're doing, the leaders, and find out from traders that are putting to action, and that's what we're having at this workshop in Palm Beach right here in Florida, and it's going to be an amazing event. We don't have a course to sell you. If you want it, you can go to our website. We've made offers before, but I think really to apply and talk with other traders and get into being very serious about your money from winners, from people that are in the game, from people that have been calling the market right for a long time, you need to be at this seminar. End of story. Because there's a lot of people out there that they put out a lot of trades, but then they're constantly finding themselves adjusting. And I'm not telling you that every trade I make is right. That's what the risk is all about. But I find myself having to do less and less adjustments based on our style and technique of analysis. So I hope you guys can join us at the very least as a special offer with TradeStation. It's fabulous that they're doing this. And even if you are thinking of getting back into the market and you don't know who to open an account with, at least with this opportunity, you can find yourself with any of our tools and trading techniques. TradeStation can help you out there. So with that said, if you are considering, come visit our website at personsplanet.com. You will find that you can get the information that you need about this incredible seminar. And I think it's fabulous because of the fact that we have not just me, it is a student who has taken his trading to the heights that everyone wants to be at, and he's gotten it. So if you click over here on our website and you go to seminars, and you go to 2-day seminar event in Florida, right? And this is it. This is Florida. Man, it's going to be right on the beach. It's in Singer Island here in Palm Beach County. You've got golf courses. We've got the Palm Beach Yacht Club. We could do private dinners there. We're members there. You can go, which is very nice. We are thinking of doing a lot of fun things together as a group. When we were at seminars at sea, we did all kinds of fun things. So we plan on having some extracurricular activities. I'm not saying that there may be a wine tasting dinner involved, but there's something that we could do there. And you can read about why is this seminar different. You can read about what we're talking about, and it's exactly kind of the techniques that we are sharing and been using and still use to this day. So here's Dr. Scott, Jeffrey Scott, and he'll be there. We're going to have our very own Sonia Irwin come down. Sonia's a trader, individual trader. She's just a great person, and she has been helping out with our business to help build our education to get people on the right track. And again, there's my lovely wife, Mary. She's the boss, and that's what we will be doing for this seminar. And in fact, you will be getting, if you don't have TradeStation, you open that TradeStation account, you'll be getting my high close, low close doji triggers free. That is incredible. They are very powerful. They're wonderful tools, and instead of you can automate it, but you can more importantly use it as a hybrid. So in any event, Mitch said that, Paul, yes, the radar screen is included for free, and I remember even myself having to pay for that, so I'm a little bitter that they're giving it away for free to you just because of coming to tonight's seminar. That's that's crazy. So, Mitch, you're buying dinner sometime. If you give them that, I at least am going to get dinner out of you, buddy. No, just joking, just joking. So anyway, we wanted to say thank you to Mitch and to everyone. I hope you got something out of tonight's presentation. I really do. I think we provided information that, A, what's really happening in the market. It is a cycle analysis. So there is some what we need to look at going forward, of course, with the advanced decline analysis. You know, the funny thing is we look at some of these stocks and you go, you know, we are looking at some deterioration. Like this is USB. I mean, no matter what I look at, and I see USB making, I mean, if I flip this chart upside down, it would almost look like an inverted saucer. It looks like a little saucer bottom, so it looks more like distribution than accumulation. I'm sure you can see that. And so we want to look to see if maybe, you know, this is a monthly chart. We didn't generate a sell signal, but I could say that if this market is looking healthy, then we wouldn't have that divergence in that momentum histogram. Market made higher highs over time, and we have lower readings. When we take a look at the advanced decline, I mean, that was a little sick move today. It was awesome. It gave you a chance to cover some of those puts, which we did, by the way. And I'm thinking maybe a 1 to 2. Maybe tomorrow we got the unemployment report, and for Friday, what we need to do is to see how this market closes. By the way, you talk about a low close doji. That's a doji, and that's a low close doji on a weekly chart. And if we do finally generate a weekly sell signal, that's what that pink dot is. It doesn't mean it's locked. It's warning us that we're going to get a sell signal. Rallies back potentially to around the 40 to 48 area, somewhere up in this region in the next week, will offer maybe another sell opportunity. So if Friday we close lower, we'll probably get an opportunity for a small, if we close here and generate that sell signal, you want to still be selling into next week. So I can't tell you that information until tomorrow's close, but at least you all know that if you close at, you know, right here, it generated, flashed that warning that's 1929 3/4. Guess what? We had a little pop down there, the advanced decline on the weekly basis. Had a nice little breakdown. That's the AD line right there. And the next major level of support is going to be another, not a big deal, 30 handles, which is around 1905, which is, you know, right around that white line right there. After that, I mean, we start digging into like 1875. That would be, I think everyone would then, you know, be ready to say, maybe I should have held off and buy, you know, instead of getting, you know, drinking the Kool-Aid up in here. I will, if you guys get emails, if you're on my email distribution list, I'm just going to share something with you. Every Monday, maybe you guys don't see it, but maybe if you do get my emails, are you guys getting the, we do the market observation and events? Do you guys get this John Person Weekly Planner? We send this to our entire database. Do you guys get this? And if you look at this and you actually take the time, if you read it, and I know everyone gets a ton of stuff in their email boxes, but this is this actually will tell you what we were looking for and what we are looking to do. So like, for example, we tell you the bond boys know best. Smart money buying bonds, perhaps leaning less and less towards adding equity positions. That was my comments. We believe the market is ready for correction. Look at the daily market. Look at the major post blah, 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 post there. We went and did that. We were telling people what we are seeing. In addition to that, we give you what the July seasonal trends are. We're going to have a new one for August because today's August. We give you potential day and swing trades. Low closed dojis on a week. We had 36 signals versus only 18 buys. Twice as many sell signals last week as buy signals. That right there was a tip-off that we were looking at further weakness in the market. And then what we have is we list all the reports every week. This comes out with all the reports that come out and the earnings. B stands before, and if you see here, A, maybe I need to make that a little bit better, but A stands for after the market, so you get a listing of everything, and then you can get some details of what we're doing. This comes out every single Monday. We send that to our database. So if you're interested, just pick that up, and you kind of get, as I say here, it still smells like significant caution is warranted. And I remind you that a few longer-term put options in September and October expiration are in order. And that came out, as you can see, Monday at 11:09 a.m. to our entire database. So if you do get that, maybe you want to look for your email box, and we will have an update. So Monday, we'll send another market observation. We do that as a courtesy, just to give you guys in tune as part of our, clients. And if you're not a client, we wish you are and will be, and we want to wish you a great evening. And sorry to take so much of your time tonight, but hopefully you get something out of tonight's presentation. So anyway, the emails are there. If you are an email to come to tonight's presentation, so then you must be getting these. So make sure you look for the weekly planners and you get that stuff. Okay? Awesome, everyone. Thank you so much. And if you guys have any questions, certainly feel free. You can contact, where to find us, personsplanet.com. Everyone, have a great evening. I hope tonight gave you some great insights. Thank you.